So what happened is Jimmy Carter in '76 was able. Plus, these people, regional pride is always biggest with the lower intellects and lower income groups. So on the basis of regional pride, I'm one of you, and fuzzing the issues and making it look like, being a born-again Christian, which smacks of conservatism, and trying to be conservative, he gets that group in mass in '76, carries the whole South. Well, once he got there, and this is an important point of what I'm going to say, it was his to lose. It wasn't ours to win, it was Carter's to lose. All Carter had to do was run in place. Well, he didn't do that. He took that for granted, he went out, didn't stay on the issue, and we were able to go back in, which I didn't think we were going to be. I thought we could really lay him in hamstring and bring him back in there. But what he did is to fall is on turf, not on anything to do with racism or the race question, but on economics and on national defense. It was his to lose. So the fact of the matter is the South is Reagan's to lose now. And as long as if Reagan goes and denounces his own economic policy or doesn't balance the budget, or he could lose the South. But if not, he's going to get the South.
But he's not going to lose the South if he goes along with what the blacks want to vote.
That should be a thrust of his. In other words, in 1968, the whole Southern strategy that Harry has put together, the Voting Rights Act would have been a central part of keeping the South. Now they don't have to do that. All you got to do to keep the South is for Reagan to run in place on the issues he's campaigned on since 1964. And that's fiscal conservative, balancing the budget, cutting taxes, the whole cluster, and being tough on national defense. And it's going to be very hard for Reagan to do.
But I'm not saying that he does this consciously, but the fact is that he does get to the Wallace voter and to the racist side of the Wallace voter by doing away with legal services, by doing away with cutting down on food stamps.
Here's how I would approach that issue as a statistician or a political scientist, or no, as a psychologist, which I'm not. Is how abstract you handle the race thing. In other words, you start out, now y'all aren't quoting me on this. All right. You start out in 1954 by saying nigger, nigger, nigger. By 1968, you can't say nigger. That hurts you, backfire. So you say stuff like forced busing, states' rights, and all that stuff. And you get so abstract now, you're talking about cutting taxes, and all of these things you're talking about are totally economic things, and the byproduct of them is blacks get hurt worse than whites. And subconsciously, maybe that is part of it. I'm not saying that, but I'm saying that if it is getting that abstract and that coded, that we're doing away with the racial problem one way or the other. You follow me? Because obviously sitting around saying we want to cut taxes, we want to cut this, and we want is much more abstract than even the busing thing. And a hell of a lot more abstract than nigger. So any way you look at it, race is coming on the back burner.
Buy Black Podcast, episode 21, How the Black Community Can Make the New Tax Reform Law Work in Our Favor. Welcome to Buy Black, the only podcast dedicated to helping you find, connect with, and support Black-owned businesses. We're on a mission to bring consumers and business owners together to ignite the global Black economy. I'm your host, Gerald Jones, and if you're a Black business owner or a socially conscious consumer, you've joined the right community. Ready? Hey guys, welcome to Buy Black, your only podcast dedicated to helping you find and connect with Black-owned businesses. It is January 1st, 2018, and we are trying out a little bit of a new format going into the new year. Over the break, you might have heard in the last episode, I've been working really hard to get buyblackpodcast.com online, and it is up. It is officially launched. And first things first, the number one thing that I want you guys to do with this website is I want you to go visit it, and there is a page on there called Buy Black Resources. I want you to check out that page because Yes, you can find all the episodes on the site. Yes, we're going to start blogging. There's all this other cool stuff on the site. The directory is going to be there. But I want you to check out Buy Black Resources. On that page, I have 201 as of today, 201 links to resources that you can use, that I can use, that anybody in the Black community can use for everything from business to education, professional networks, finding motivational speakers, have some pieces broken out by region, by state, Black-owned business directories, pretty much anything that you could need, want, or anything that's going to propel you forward in wherever you are in your life. If you are Black, that page has a resource for it. This was an idea that was brought to me by Mike De Los Santos. I'm telling you, Mike has given me so many great ideas running through this project. And one day we were talking and he said, what we really need is somebody to curate the curators, because there's a whole bunch of Black-owned businesses out there. I don't know which one to go to. Or I'm sorry, there's a whole bunch of Black-owned business directories out there. I don't know which one to go to. Some have some things, some have others, whatever. But nobody uses any of them. They're hard to find. So what we really need is just one place we can go where we can find everything. And so I took that and I was like, all right, well, let's go beyond directories. Let's just see what all the resources are. So I found 200 websites, verified all the links. So all 201 of them work. And I know that there's so much more out there for us. So I want you to go check out this page. On that page, there's a button that says add link. And there's a button that says share link. And I'll actually put the link to that page down in the show notes for this episode as well. But you can go in there, and if you have a resource that you use regularly or that you find out there in the world that can help anybody in the community, you can go in and you can add links to my list. So now we have even more resources in one place that are going to help everybody else out. And then also, if you have your own website, you can actually take my entire list. You can click one button on there that says share list, and it'll give you an embed code, and you can actually embed the entire list into your website so that people can come to your website to get access to all those resources as well. All right. So just making it easy. Like I said, this whole thing, if you go to buyblackpodcast.com, the very first page at the top, you'll see, say the website is the #1 place for Black entrepreneurs and consumers to connect. And then the tagline is make it easy. That is what I want to do through all of this. It is too hard for us to find each other, to connect with each other, to buy within the community. I want to make it easy. I don't care if you get the information from me or if you get it from another website that you found through me. I just want you to be able to come to one spot, and then from that one spot, get anywhere that you need to go to solve your problems economically in the Black community. That's what this site is going to be about. So before you do anything else, check out that website and share it with people. Let them know the resources are there, and start building it. Start making it even bigger. All right. So with that, let's move on to the topic that we have for today. Today's topic is going to be about tax reform. What you guys just heard in the intro, this was a snippet from an interview that a guy named Lee Atwater did back in 1981. He was the chief strategist for Ronald Reagan getting elected in 1980. And this was an interview that he was doing while he was in the White House. And the piece that you guys heard was basically, the interviewer was asking him, what is it that is going to make Reagan continue to win? How is he going to continue to get these Southern votes going forward? And Lee basically tells him, it's like, look, the game has changed. The terminology has changed. We have to code our language a little bit differently. We got to be abstract. So whereas, 30 years ago, we could just go out and we could yell, nigger, 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 and all the racists would jump on board. Yep, absolutely, I'm voting for this person. He hates them too, right? But then you have 1964 with the Civil Rights Act. You got 1965 with the Voting Rights Act. And so now you can no longer just openly cut black people out of the loop. You can no longer just openly be racist, because now that's going to hurt you on a national scale. So you have to change your terminology. You have to code it a little bit differently, right? And so, you know, he talked about the evolution from, you know, forced busing, forcing us to integrate, right? But then finally he was talking about the terminology that Ronald Reagan used, tax cuts, right? The most abstract thing of all. It's all completely economic. But as he said, the end result of the policy is blacks get hurt worse than whites. And you heard in there, he said, you know, maybe that is part of it. Maybe, you know, subconsciously, we want black people to get hurt worse than whites. I'm not saying that's the case, but maybe that's how it is. But in either case, when you're just talking about economic things, cutting taxes, yeah, we know it's going to hurt black people, and we know it's going to make the racists happy, so they're going to vote for us. But we don't have to actually take that moniker of being racist ourselves, because we're not talking about race, right? We've completely done away with the problem of having to get the racists to vote for us by telling them we're racist too, right? That's the strategy. So I wanted to start off with that little clip because it ties directly into where we're going here in 2018. As you guys know, we just had a new tax reform law that was passed just before Christmas. I think it was on December 21st to 22nd. And it promises a lot of changes coming down the pike for taxes, for individuals, and for corporations. And we need to know how to take advantage of this new tax reform. Because yes, it is intended, these things are intended to help a certain group of people, hurt a certain group of people. We know who we are. But it only hurts us so long as we remain in the seat that they want us to stay in, right? This tax reform law can be a benefit to you, to me, to anybody who decides to interpret it and then take the actions that this tax reform wants you to take in order to take advantage of it. And so that's what we're going to talk about today. We're going to talk about what this tax reform really means for black people in the United States, and we're going to talk about what we can do to take advantage of the new tax reform as it's laid out, so that we are not sitting here beholden to somebody else's game and sitting here as the pawns that they know that they're going to move the pieces around so that we get hurt worse than everybody else. That only works if we just stand by and let it happen. So we're not going to let it happen. All right, so as we're getting started in today, anybody who's watching the video, guess what? I'm recording video now. Reason for that, the website is up, and I just connected with a man named Darren Marion. He runs a company called Ratel SEO. It's Ratel SEO. You want to look him up. Darren is a wizard when it comes to SEO. He literally, over the last 2 days, got my site SEO ready, got it indexed with the with Google, with the other search engines, and put some plugins in the back end of my WordPress site that helped me see, you know, what my SEO ratings are, how I can make the SEO better, what kind of links to put in, this, that, and the other. And then he was also teaching me along the way. So this man, I'm telling you, I'm going to put a link to his website inside the show notes. If you have a website at all, period, dot, and you want people to find you, I don't care if it's for your business, for your blog, for whatever, you want to reach out to Darren, because he will not only get you right, but he will also teach you along the way. So it's like you're paying for the service, but you're also paying for a lesson so that you can do it yourself from that point forward. It is absolutely well worth it. This man is 100% worth the cost of doing business. So I'm going to drop a link to his website down into the show notes, and you guys reach out to him. That all said, you know, part of what he was telling me is YouTube. YouTube is a huge source of just free clicks and free traffic. So I'm going to start making the shows available on YouTube as well as everywhere else. In order to be on YouTube, got to have a video. Instead of just throwing up a picture with the audio and putting it up on YouTube, I'm just going to go ahead and record the video so we have it all. I'm going to do everything I can to pretend like you guys are not there. I'm just going to do my process, but now you can see it. And if you watch the video and you got questions about anything I have in my office, like my Kanban board, this back here, it's got all my project stuff on it, or anything else going on, you know, we can do that over time. We're going to be together for a while. I don't plan on this project down anytime soon, but I do plan on getting to the point because I'm kind of rambling now, and we're not going to keep doing that. So jumping right in, what tax reform really means for black people. We're going to start with breaking the tax law down from an individual level, and then we're going to break it down from a corporate level, and then we're going to talk about what it is that we can do to take advantage of it. All right, so starting off with the individual level. Quick disclaimer, I am not a tax accountant. I am not a tax attorney. You definitely want to talk to one of those experts right here, video. You want to talk to one of those experts before you do any of the things that I'm going to recommend in this episode, because I'm just a dude who loves to read and who has common sense. That is not good enough to give you legal or tax advice, so do not take this as such, right? It's just the information to get you started. That being said, breaking down the tax law on the individual side. Some key provisions in the individual side. I'm going to break down what it is. I'm going to give you a little bit of my opinion on it, and then we're going to keep moving because this can go long. There's a lot of stuff that changed. All right, so starting off, number one, tax brackets. So supposedly the number of tax brackets was going to get smaller. That's what this guy promised back in the day. That did not happen. We had 7 tax brackets before. We still have 7 tax brackets now. The difference, however, is that the percentage rates on individuals has gone lower for people making more money, and also the brackets, the size of the brackets and the income that goes along with different brackets has kind of changed. So just looking at the changes as they came through, what we used to have was tax brackets of 10%, 15%, 25%, 28%, 33, 35, 39.6%. That's what we used to have. And looking at it just from a single standpoint, I'm not going down the list of married and head of household and married separately and all that kind of stuff. Just looking at single, because you can look at your own tax brackets, you know, after you get done driving or whatever you're doing, listening right now. So what it used to be is that if you made less than $9,500, you were at 10%. If you made less than $38,700, you were at 15%. And if you made less than $93,700, you were at 25%. If you made less than $195,000, you were at 28%. If you made less than $425,000, you were at 33%. And then basically there was a wow, this is kind of dumb. There was like a $2,000 gap there for single, where if you made between $424,950 and $426,700, you were taxed at 35%, which is pretty dumb. And then anything over $426,700 was at 39.6%. So that has changed, and now it is 0 to 9,500 is 10%. No change on you if you don't make that much money. 95 to 38.7 is now 12% instead of 15. 38.7 to 82.5 is 22%. 82.5 to 157.5 is 24%. 157.5 to 200 is 32%. 200 to 500 is 35%. And over 500 is 37%. So the rates went down just a little bit. One key thing that I noticed here, the 35% range now is anybody from 200,000 to 500,000. So that means that pretty much anybody who made between 200,000 and 425,000 just got a tax increase with this law. They just got a tax increase. So, you know, it is what it is on that. But down below, when you're looking at lower income, it really didn't change much. And we'll go further into why none of this really matters a little bit later on. But let's continue. The very next thing, the standard deduction. So the standard deduction for a single person used to be $6,300. That basically got doubled. It is now at $12,000. If you are married, filing jointly, that standard deduction is now $24,000. So the reason why a lot of this stuff doesn't really matter is because your standard deduction basically just got doubled. But the backside to that is there's this thing that we used to have called a personal exemption. So basically $4,000 that you could deduct for you and for all of your dependents. So for a person like me who had, 4 dependents, that meant that there was my $4,000 and then my wife's $4,000 and then my daughter's $4,000 and my son's $4,000 and my daughter's $4,000. That was a whole bunch of money that I got to deduct because there was a lot of people depending on my income. Personal exemption is gone, y'all. There is no more personal exemption. So if you have a large family, a lot of kids, a lot of dependents who all depend on your income, that is a huge tax hike. Because if you look just for me, all right, I'm just talking about my circumstances right now. Married filing jointly, $24,000 standard deduction. Sounds great. But when you take my $4,000, my wife's $4,000, my son, my daughter's $4,000, so now we're talking about 16 right there, and then my other daughter's $4,000, so that is $20,000 right there, just in personal exemptions that we're not going to get, right? And then you talk about all of the other things that I normally would deduct, right? Probably will end up still having to deduct. So I am probably going to be one of those people who's in a situation of I'm losing money because I can't make those deductions, and then all the other things that I would be deducting, they're not starting from that $20,000 in deductions I have for the personal exemptions. It's starting basically from zero and trying to work its way up past 24,000. And they're not going to work their way past 24,000, which means that I have to take the standard deduction because itemizing for me is not going to make any sense. Whereas under the old rule, I would basically be starting from, a $20,000 personal exemption, and then also my standard deduction, the $20,000 in personal exemption was over the standard deduction already, so I'm in a really good spot. And then my itemized deductions on top of all of that. So, yeah, my taxes are about to go up. Just throwing that out there. Yeah. So, personal exemption, gone. What's next? Child tax credit. So, the child tax credit, here's another piece of this that I am not a huge fan of. The child tax credit used to be $1,000 per child. Right? They just doubled that, though, to $2,000 per child. So it's great, right? Everybody's excited about that, except it's not exactly $2,000 per child because only $1,400 of that is refundable. So what that means is that whereas you used to be able, let's say you had, let's call it 3 kids, like I've got, right? So you had that $3,000 worth of child tax credit, and it was all refundable. Well, where now you have the $1,400 times 3, so that's 28, 38, 42. All right, so that's $4,200 that would be refundable against your taxes, right? But the other $600 per child, that is not refundable. Which means that if at the end of the year you get a refund, that $600 per kid does not apply towards that refund. All right. What it does apply to, though, is if you owe money at the end of the year, then that extra $600 can go towards the money that you owe. So basically what it's saying is if you are a middle income to upper middle income person who ends up owing taxes and you've got a bunch of kids, we're going to give you more money towards a reprieve on your taxes for those kids, which is fine. There's nothing wrong with that. But the thing about that is that used to be capped at, I think, about $110 or $110,000. So once you made more than $110,000, you couldn't get the child tax credit at all, right? But they just raised that to $400,000. So what that really does is now anybody making up to $400,000 a year has the ability to get this extra $2,000 per child credit on their taxes. And presumably people making that much money they're going to owe taxes. So this is just a break on taxes for people who are making a larger amount of money. That's really all that is, right? If you are making a lesser amount of money, then it's really not going to be a break for you, because remember, going back to your doubled standard deduction, and they're taking away the personal exemption, so that doesn't get you anywhere near that. So these child tax credits that you have are probably not going to get you anywhere near to the level of that standard deduction. So it's like they just kind of go away. Is really what it is a child's tax credit goes away if you are, middle income, lower middle income, or below that. It's basically how it kind of is going to shake out with the standard deduction being what it is. All right, so what's next? Credit applies 400,000, formerly 110, add 500. Yep. There's an additional credit, a $500 credit for non-child dependents. That could be college students or elderly parents. So if you are taking care of any dependents who are adults, you get an extra $500 in your credit. That's good. All right. Next thing to change. This is for you people living in states that have really high property taxes. There is now a cap on the state and local tax deduction. So if you're paying property taxes, if you have high taxes that you have to pay for your state, you used to be able to get a deduction for that. There's a cap on that now of $10,000. So it's really not going to affect many people. But if you pay more than $10,000 in taxes to your state or locally, that deduction is going away. All right. Mortgage interest deduction. If you already have a mortgage, then this is not going to affect you. But if you are getting a new mortgage, you can only deduct the interest paid on a debt up to $750,000 for your mortgage. So if you go out and buy a house that is $1 million, you're not going to be able to deduct the interest on that $1 million house, but you can deduct the interest on your $750,000 house. That does not affect anything with mortgages that are already out. It's going to be mortgages that are new. All right, next things, student loan interest. They didn't take away the student loan interest deduction, so you can still deduct up to $2,500. That's not bad. Medical expenses, anything over 7.5% of your average gross income. Is it average gross income? Adjusted gross income is going to be deductible, right? So that's a good thing. Medical expenses used to be had to be over 10% of your adjusted gross income that you spend in medical expenses, and then you could deduct them. Now they've lowered that. Anything over 7.5% you can now deduct. However, that's only good for 2 years. It's good for this tax filing year for 2017. It's good for the next tax filing year, 2018. And then after that, it goes back up to 10%. So this is short-lived. Other things, they were talking about cutting out the deduction that teachers can make for buying supplies for their classroom, but they didn't mess with that. So you can still deduct up to $250 for that. There's an electric car tax credit of $7,500 that you can get if you buy an electric car. That is still in place. However, there is a limit on that. If you were thinking about buying an electric car, this tax credit is only good on the first 200,000 vehicles that any manufacturer sells, right? So specifically, let's just go with Nissan. All right, so Nissan is projected to sell its 200,000th electric car in this coming year, in 2018, which means all the people who bought electric cars all the way up to that 200,000 all get the $7,500 tax credit. But if you go in and you buy the 200,001st Nissan, you do not qualify for this credit, and nor does anybody who buys an electric Nissan car after you for all of history, right? So if you're looking at buying an electric car, there are, let's see, GM, Nissan, and Tesla all are projected to hit their 200,000th car in this coming year. So if an electric car is on your list, take a look at those manufacturers. You can still get in under the radar, buy one of those vehicles, and still qualify for the $7,500 electric car tax credit. All right. Other changes here. 529 savings plans. I don't know if you've heard of these, but a 529 savings plan is designed to save money for college. They made a change in this tax law now where you can actually use up to $10,000 in your 529 savings plan to pay for private school. So rather than having to save that money to use for college, if you want to put your kid into private school and you're putting this money away tax-free on the side to pay for your kid's education, you can use that money, up to $10,000 of it, withdrawn to pay for private school education. That is a change that they made going forward this year. Other things coming up. This is for you unhappy people out there in a marriage that, might last, might not. This is going to affect it. Alimony. I didn't know alimony is tax deductible because I don't pay it. But apparently it is. And apparently it's not going to be anymore. So for any separation papers or divorce papers that are filed after December 31st, 2018, so that means you have a year from now, but for any separation or divorce papers filed after 2018, the alimony tax deduction will not apply. So if you get divorced or separated after December 31st, 2018, guess what? However much money you're paying in alimony every month, at the end of the year, you're not going to be able to deduct any of those expenses from your taxes. So, if you're on the fence in 2017, y'all need to decide whether to keep it together or call it quits by December 31st because, it's going to hit your wallet even more than it already would have. So think about that. Be happy. Stay in your marriages or don't. It's up to you, right? You do the thing that makes sense for your wallet. All right. What's next? Disaster. Oh, this is one that bugs the crap out of me. Disaster deduction. So it used to be that, if you had theft, if somebody broke into your house and stole a bunch of your stuff, or if you had a disaster happen, like your house caught on fire and you lost everything, you could deduct that. Well, they've changed the rules now, and the only way that you can deduct it is if this loss happened in an actual declared federal emergency, in an actual federal natural disaster. So that basically means that if let's go with an act of God, right? Lightning strikes your house catches on fire, you lose your house. You can't deduct that total loss from your taxes. Lightning strikes a tree in California, sets that tree on fire. That tree creates a wildfire. Federal government declares that a natural disaster. You lose your house. You can deduct that. So, yeah, that's where we're going now. All right. Apparently, your disaster on your taxes doesn't really matter unless the rest of the nation is having the same problem, I guess. I don't know. Whatever. Let's see. Other things we're losing. You used to be able to deduct moving expenses for a job. Can't deduct those anymore. You used to be able to deduct the cost of preparing your taxes. You know, paying somebody else to do that who went to school for it, who's not going to mess it up and get you going to jail. Nope. Now you can't deduct that cost either. So let's encourage you to, do your taxes on your own and pray for the best. But you really won't have much to do because we're all going to be taking the standard deduction because they doubled it and they took away all our exemptions and the entire reason for us to itemize. So, yeah, 6 in one hand, half dozen in the other. Other things that changed on this tax bill. The individual mandate for the Affordable Care Act. It didn't get repealed, but they changed the penalty to 0. So, in essence, it got repealed. So if you decide that you don't want to get health insurance next year, there's still a tax penalty for disobeying the law, but that tax penalty is now 0. Which means that a lot of people are probably going to choose, if they're healthy, I'm just not going to buy health insurance, which is, of course, going to make the pool smaller, which is going to drive premiums up for those of us who are paying. It's also going to make it more difficult on subsidies and things like that. So just understand that is coming. So good for some, not so good for others, just like everything else going on in this tax bill. Moving on. Here's a nuanced thing that we're going to talk about. The way that inflation is gauged for tax purposes is being changed. What we used to use in order to gauge the rate of inflation was something called the Consumer Price Index in urban areas. What that really means is basically how much things cost for people to buy them in urban areas, in places where there are markets and shops and they can go and they can buy anything that they need, right? Now, they're changing the way that this is going to be adjusted to use something called chain-weighted consumer price index. All right, what that really means is that they are taking into account the idea of substitution products, right? And substitution products means that I can buy this thing or I can buy something that is a close substitute to it at a lower price. And people typically, when prices go up, they don't just deal with the higher price of the thing. They start to substitute that particular product with another product that does the same job, but they can get for less. And so what that really means is that the inflation rate, as far as how people feel it in their pockets, is much slower than the inflation rate as it is reported when prices go up on certain products. If we can substitute a product and get it cheaper, or we just don't buy that product anymore and we buy something else, then that it keeps our dollars from running away from us as quickly as it might seem it would with prices going up. So by switching to the chain-weighted consumer price index, that means that the rate of inflation for tax purposes is going to rise a lot slower, even though the rate of inflation technically is rising faster. So when you talk about adjusting income brackets for tax purposes, as it stands right now, looking at the new marginal tax rate, I'll just use one example here. This is how this is going to apply. Looking at the single rate, let's just say between $9,525 to $38,700 as a single person. Right now, your tax rate is going to be 12%. But if you make between $38,000 to $82,500, your tax rate is 22%. Right? So what this means is, as the years pass, as your income increases, typically the rate of inflation is going to either match or outpace your level of income. And so as the rate of inflation outpaces it, where we used to say a person making 38.7 is going to get taxed at 12%, it would probably go up and say, hey, a person making 41.5 is going to get taxed at 12% because of inflation. 41.5 buys today what 38.7 bought 3 years ago, right? But what instead is going to happen now is, well, I was making 38.7, now I'm making 41.5. The rate of inflation says, oh, now a person making 39.5 can buy what a person 3 years ago could buy at 38.7. So we're going to raise the tax bracket for 12% up to 39.5, right? Why did it only go up so much? Because it's like, oh, well, those people making more money, they shifted their products. And so even though prices are a lot higher, they're buying cheaper products. So really inflation is only this much, not actually that much. So now that lower tax bracket is going to cut off at 39.5, but over this last 3 years, your income has risen to 41.5. So now your tax rate is going up by 10% to 22% from 12%, right? So that's what that basically means, is they're making it where for tax purposes, these brackets are going to rise really, really, really slowly, probably a lot more slowly than your income actually does, and probably a lot more slowly than real inflation that's going to hit your pocket actually does. So you'll probably end up paying more in taxes over time based on this new process. That said, if it's more accurate, then it's more accurate. And it's just, it's one of those loopholes that they found of, we can do something that's going to save us a little bit of money, raise people taxes a little bit, but we can defend it by saying, well, this is more accurate. And if it hurts people, then it hurts people. That's how it works. That's how the game is played. So those are basically the major changes that happen for individuals. And so check this out. Here's the other thing about your brand new tax reform for individuals. It is only good until 2025. So these lower rates, this 10, 12, 22, 24, 32, 35, 37, that is only good until 2025, at which point all of this reverts back to what we had before. Rates go back up. Everything goes back to the way it was. So really doesn't matter at all. But for the next 8 years, right? Or 7 years, that's where we're at. So I'll come back around to that a little bit later on. Trust me, I will. Right now, what we need to do is move into the business side of things, how this tax reform affects businesses. And guess what, y'all? This tax reform was not about us as individuals. It was not about you. That's why the individual part is only temporary. That is the hush money, because the real changes were intended to be for businesses, for corporations. That's where we're going to see the long-term effects. So let's jump right into that. Let's go straight to the corporate tax rate, right? So the tax rate that C corporations pay, the top marginal rate used to be 35%. That rate has been cut down to 21%, and it is permanent. This does not end in 2025. This is the way it is from now until we have some other Congress that decides to change it, right? Where I personally fall on all this, hey, I don't have any problem with businesses having their taxes cut to match what the going rate is across the world. I don't have any problem with that. Do I think that it's going to turn around and turn into, that the money's going to trickle down? People are going to start making more money because no, absolutely not. For me, I feel like anything that makes us more competitive globally, as far as the amount of money that we are either investing or that we are throwing away into the tax bucket, I'm all about something that's going to make your business, my business, more competitive across these borders, because this is 2018 now, right? Everything is global. Everything is global. You can start your own business tomorrow from home and be global. So I am all about us being more competitive and having tax rates that are more competitive. Just helps more people want to get into the game and gives us a lot more options. All right, so that soapbox aside, C corporations permanently taxed lower to 21%. Now, pass-through entities. If you are not aware, if you're not familiar, a pass-through entity is basically a business structure, a legal structure of a business where the profits that a company makes are represented as income on the taxes of the people who own the company. So if you have a sole proprietorship, which means that you are an individual owner of a company and you're set up as a sole proprietorship, if your company makes $150,000 profit, then that $150,000 profit is reported as $150,000 of personal income that you made this year on your taxes. If it's a partnership, same thing. If there's two of you who run the business, you made $150,000 profit. Each of you has a 50% stake in the company. Then there's $75,000 of profit that's going to be seen as personal income for you, and $75,000 is going to be seen as personal income for your partner, right? That's how it works. So with a pass-through, since it uses individual tax rates, they're really not getting in on the lower tax rate that you get from a corporation. So what they did with this bill is they added a blanket 20% deduction for pass-through income. So just to keep the numbers even, I said 150, let's use the example of 100. If your business made $100,000, right, and you're representing that as your personal income, you immediately get to write off 20% of that, right? So $20,000 immediately, that income, that deduction is there for you. So now you're actually reporting on an adjusted gross income of $80,000, and then all the other personal things come into that, your personal deductions and all this other stuff, right? So that's a really big tax cut for pass-through entities. Now, there are some limitations. Once you get past, making $157,000 for an individual or $315,000 for married filing jointly, but you got one of these pass-through entities, then the rules can change. And then also, if you happen to be a doctor, a lawyer, an accountant, a consultant, like myself, any one of those professional services, once you make above a certain amount, this 20% deduction does not apply to you. So there are some limitations. There are some things that if you have one of these businesses that is a pass-through and you make a certain amount of money with your company, you got to look at what industry you're in and all these other pieces to see, do you qualify for this 20% deduction across the board? But ultimately, if you're below that threshold with the money that you make, you get that 20% on top of everything else, which is really nice, right? So it's a great reason to start a business. Moving forward. Yeah. So I was going to say, looking at that, right, you may end up seeing a lot of these professional services like, like law firms or, accounting firms or consulting firms, things like that. Whereas they, in a lot of states, would get set up either as a professional or a limited liability partnership, or just a regular partnership, usually a limited liability partnership, or professional partnership. There's different structures for them in different states. There's no way I can speak to all of them. But instead of doing that, where there's basically a huge pass-through, If these firms are really successful and they're bringing in, hundreds of thousands, millions of dollars, and they're in those structures, it may behoove them to leave the pass-through structure and actually set their firms up as C corporations. And some states have professional C corporations that they can set up as specifically for those industries. So this new tax structure could affect the way a lot of businesses decide to structure moving forward. And if you want a refresher on things about sole proprietorships, partnerships, LLCs, C Corps, S Corps, all those different things, you can go back to episode, I believe it was episode 4C of Buy Black Podcast. I will put the link down in the show notes of this episode for that. It actually talks about all the different advantages and disadvantages that go along with getting set up, whether it's as a sole proprietorship, partnership, LLC, or a corporation, C or S. Obviously, a lot of that has changed because of the new taxes, but a lot of it still remains the same. So go back, check that episode out. It could really help you out if you're thinking about starting a business this year, looking at what structure will be best for you. Also, the follow-up on that episode was things to know before you pay another company to set up your LLC if you decide to go that route. Those are really good resources. I've had a lot of people ask about them, and I've sent them out when folks reached out to me asking about, hey, what do I do here? How do I set that up there? So those are in the archives. Reach out to them if you need them. Moving forward, other things about business. So here's another concept. When we talk about accounting, we talk about how companies keep up with their money. There's a change in the new tax law that raises the amount of revenue that a company can have and still use cash-based accounting practices. So this one is definitely one you want to talk to your CPA about. If you have a firm that is bringing in over $5 million. So there's generally two different ways that a company can account for their income and their expenses, their profits and their losses. And the one way is called cash-based accounting, and the other way is using accrual-based accounting. And the one that is acceptable, the one that is that goes along with what's called GAAP, generally accepted accounting principles, is accrual-based accounting. And the big difference with that is that with cash-based accounting, you account for your income and expenses based on the money that you have on hand today, not based on when you agreed to purchase or sell something, or when you agreed to pay for a service or provide pay for an expense. Whereas with accrual-based accounting, you account for that income, or you account for that outflow of money at the time that the agreement is made to either pay the money or receive the money. And I'll see if I can break this down real quick. Some great example here to understand that. With cash-based accounting, let's just say that I've got a business, and in my business today, I made a sale to a client. They signed the paperwork on the contract, and they purchased my product. All right. However, they don't pay the invoice until the middle of February. With cash-based accounting, I would not count that money coming into my coffers until I receive that money on the middle of February. I wouldn't write anything down about it today because I do my accounting based on cash on hand. Whereas with accrual-based accounting, or accrual-based accounting, I am going to count that money today. I made the sale today. The contract is signed today. So I just accrued that revenue today. And so it's going to come and it's going to be accounted for on my books as of January 1st. The reason why this is more acceptable at a larger scale is because it gives you a much better picture of where a company sits financially, what kind of shape they're in, right? Because if I've got a whole lot of money that is sitting in my accounts receivable, right? I know right now it may look like, hey, I've only got $5,000 on hand. But if you look at my accounts receivable, I've got $155,000 in accounts receivable. All right. Sales that have already been made. The invoices just haven't been paid to me yet, but that money is coming in. So you can see today, if you look at my books, that I'm really sitting in a great position when it comes to revenue. Got $160,000 in revenue, right? Or $155,000 in revenue plus $5,000 in cash. You got $160,000 in assets. You can see that right now. Whereas with cash-based accounting, on the exact same day, you look at it and you say, man, your business is about to go under. You only got $5,000 on hand. Well, I mean, I got $155,000 coming in. I can't see that though, because you haven't recorded that. And so with cash-based accounting, it gives you a picture of what money you have on hand today. And it is much simpler to use. And so even though it's not part of generally accepted accounting principles, when you have a small business, it's a lot easier to function and it's a lot less confusing to just use cash-based accounting. However, the rules all the way up until now said if you brought in revenue of over $5 million a year, you cannot use cash-based accounting. You have to use GAAP. You have to use accrual-based accounting, which really means you got to make sure you have an entire team of accountants who are doing this work for you, because all that accrual, all the accounts payable for things that you owe but haven't paid yet, accounts receivable, things people owe you but haven't been paid in yet, and credits and debits and all of those different things, you have to have a team of people who are managing where all that money is supposed to go and where it's all supposed to come from, and then what happens when that money actually comes in and what happens when that money actually goes out, and keeps that up to date. It's a full-time team's worth of a job, right? Whereas with cash-based, it's just money came in, mark money down, money went out, mark money down, and you're just fine. So what this new law does is it allows for companies with revenues up to $25,000. So they're multiplying it by 5 times. Up to $25,000 in revenue, up to $25 million in revenue, you can still use cash-based accounting principles. So it's not going to give you as clean a look at the books if you're wanting to, regulate the books. But if you're a person who's running that business, it makes it a lot simpler and easier for you to keep track of your money going in and out without having to use something that is a lot more expensive, because it really does require, when you're using accrual-based accounting, to have a team of people who know what they're doing and who are staying on top of invoices going in and coming out and what hadn't been paid and all that kind of stuff. You still got to do it with cash-based accounting, but it's just easier to manage the books. So that is a really long-winded way of explaining that for small businesses that bring in a lot of money, $5 million used to be $25 million now, they have the ability to use a more simple accounting method for the books. All right, so that is basically an explanation of the changes that we have going on in the taxes. As I said before, most of the personal cuts and the provisions for people expire in 2025, whereas all the corporate cuts are permanent. And this right here, like I said before, actually, no, I don't think I said this before, but I did want to make this point. This tax law can give you a peek, if you're not used to paying attention to it, in how this political game is played, how they use us, how they use the fact that we have very short memories, and how they use our emotions against us in order to perpetuate their own power, right? You got to ask yourself, why? Why is it that they would make these tax reforms for individuals expire in 2025. That seems like such an arbitrary year. Sorry, guys, a little bit of Red Bull. But it's not. It's all strategic. All right, so let's take a look at this. We get a tax cut, technically, a tax cut, a simplification of the tax code, simplification of the way that people are going to be able to file. And supposedly for a lot of people, it's going to save them money. And people like having more money in their pockets. And if this works out the way the Republicans say it will, and hope that it will, and we do have a boon in the economy, and we do see fewer people out of work, and we do see more people with more money in their pockets, people are going to be happy, right? And no matter how a person happens to be, typically people are going to vote their wallet. More than half the people in this country are going to vote their wallet. I know that much, right? Because if you look at 1984, and Ronald Reagan only had to say one thing in order to guarantee that he would get reelected. He asked the question, are you better off now than you were 4 years ago? And people looked and said, yep. Enough people looked and said, yep, I am better off now than I was 4 years ago. I will reelect him. They are banking on that for 2020, y'all. They're banking on this temporary tax cut, having people think short-sighted and say, I'm better off now than I was 4 years ago. And so I am going to re-vote this dude in. They are banking on that. So where does that put us? That means that 2020 election, we have the same president who comes into office in 2021, starting that second term. It's a 4-year term. So that means that that second 4-year term is going to end in January of 2025. Now, I don't care how much money you save or make or anything. I don't think anybody can deal with more than 8 years of this. And certainly they're not going to be electing another person like this guy after this guy, even if they elect him twice. And I think the Republicans know that. And so you create a tax law where all the goodies expire at the end of this person's second term. So in January of 2025, whoever happens to win, and they're banking on it not being a Republican because they know who this dude is and they know how we feel about him. That person comes in and immediately all of the tax cuts that we felt for the last 8 years, all this tax reprieve, if we got it, some of us won't get it. All of that immediately is gone, which means prices go up, taxes go up, economy goes down, stock market goes down. They're basically setting the whole thing up to tumble as soon as this new person comes into office. And where does that put our Republican senators and House of Representatives? People who probably will not be in the majority in the Congress by then, because if we can't get rid of the one on top, we'll do what we can to get rid of the ones who help him and put him there. We saw that they did that to Obama, and people are going to do that to Trump, right? So, I said the name. All right. But we know that's going to happen, which means that they're banking on by 2025 either being split or being a minority in the Congress, and going into a new president, all of the taxes go back the way that they were, and then being able to immediately start campaigning on day one saying, look at how horrible this Democrat president is. They don't know how to run the economy. Prices are going up. People's wages are going down. Everything was great under this dude, and now we got this new person and they're just ruining everything. When in reality, they literally set up this house of cards to tumble in 2025. That's how the game is played, y'all. If you are not looking 8, 10, 15, 20 years down the line, when you look at any, and I mean any federal law that gets passed, if you are not looking at the effects a decade, 2 decades down the line and what that's going to mean, then you're not thinking like the people who are passing these laws. There's a reason they don't read them. They don't need to, because the provisions, the individual things that we're looking at here, they don't matter. They don't matter to them. What matters is the overall effect on the political landscape that this is going to have over 4 years, over 8 years, and where it's going to put them when it comes time for them to go back in front of the cameras as the minority and make their case for why they need to be the majority again. That's all this is. Power does nothing but exist to perpetuate itself. And this particular piece of legislation is designed in order to protect the power of the Republican Party going forward for the next 8 years, to put them in position to undermine the next Democratic president as they see it coming in 2025. And, of course, in the meantime, create a permanent decrease of taxes and tax burden on the folks who are running all the business in the United States. That's what this is designed to do. And it's going to work, right? Because even though we're having this conversation, I guarantee you 8 years from now, 7 years from now, if this guy makes it through 2020 and they reelect him, then 7 years from now, it's going to play out exactly like I just said, because it's how it always does. These guys know how to play the game because they wrote the rules and they rewrite them at will. Our job is to learn the game and learn the rules so that we can start to play their game better than they can. That's what we got to do. All right, so let's talk about how we can make this work to our advantage. How do we take over the game? All right, the first thing that I saw that can be valuable, and again, this all depends on your particular financial situation, right? So the first thing that I saw that was interesting to me was the 529 savings plan, that tax-free shelter for your money for your kids' education. I know for me personally, my parents, they paid to put me through private school all the way up until I was in the 10th grade. I begged them to let me out of private school so I could go to Little Rock Central, where I graduated. And but up until that point, they had me in private school. And I got to tell you, in all honesty, I did not really learn anything from 10th grade all the way through college. Everything that I knew, everything I know now is from, reading on my own after that time period and trying things and experimenting and in the world. But when it comes to education, everything I did after the 9th grade was just a review. I wholeheartedly believe that if you have the opportunity to get your kids into a private school, into a what are those things called? A charter school, right? And of course, there's a lot of really good public school districts. I mean, my kids are in a really good public school district, right? But if you have the ability to put money aside to pay for your kids' education, and you have the ability to use that money for a private school education, I recommend it, because just from my experience, I know that I learned much more in my formative years being in a private school than I learned later on going through, high school or public or private universities, because I was in both. The foundation that you get from, kindergarten on up through middle school, that's going to carry you the rest of your life. So, personal opinion here, if you have the opportunity to use tax deferred, tax sheltered money to put your kid in private school, take advantage of it, because I guarantee you they will. The big they with a capital T. There's no reason that we shouldn't. I'm not going to be a person who argues for or against public schools, because like I said, my kids are in public school. But what I will say is that, education is a commodity just like anything else. And if you have the means to pay for a better quality, then why sit and have the argument of, no, you don't need to do that, you're leaving other kids behind? You do what you can for your family to put them in a better position for the next generation. And hopefully we get more and more of us who are able to do that. But rather than holding each other back and saying, you don't leave me here, every one of us that has the opportunity, we need to put our kids in position to have more and to create more. Personal opinion. You may disagree. That's fine. If you do, email me. I'm all about it. I love conversation. But anyway, so that's one thing. The other thing, start a small business, right? That is the next piece that we have to do if we want to take advantage of this, because this thing does not benefit the employee. This new tax law does not benefit the employee. It benefits the employer. It benefits the self-employed. And so even if you have a job, right? I have a job. I got a 40-hour-a-week job. It is a great job. Pays me a good deal of money to take care of my family. However, pause for effect, I am an employee. Having a separate side hustle business that is actually set up, even if it's as a pass-through entity or whatever, let's say you set up an LLC and you have a small side hustle business, and in your off time, you're running this business. That means that you have a piece of your home, such as an office that you use to conduct that business, and that's all you do in that piece of your home is conduct that business. Okay, great. Guess what? Deductible. You have a vehicle that you have to put miles on in order to conduct that business. You keep a mile log, and guess what? Mileage, deductible. There's all different things that are deductible when you are in some way, shape, or form a business owner and you have a pass-through. Oh, and by the way, 20% deduction on all of your profits comes off of your taxes. So you just got a huge incentive to go and start a side hustle business in the 2018, right? Be the person who signs the front of the check and the back of the check. And I got that from listening to Jay Jones over at Black Entrepreneur Blueprint. If you haven't picked up his show yet, you need to get on it for 2018. But he tells a story talking about going into the bank with a couple of his business partners, and his partners signing the front of the check as the business owner, and then turning around signing the back of the check as the person receiving it, and going to cash this check from his company, right? You want to be the person signing the front of the check in 2018 and going forward, because this game is being set up for the producer, not for the consumer. We've got to become producers, right? If you have a professional services company, I talked about this one a little bit earlier, you may benefit from switching over from a pass-through entity to a C corporation. That all depends on what your tax liability is right now, blah, 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 blah. Talk to your CPA, right? But that might be a benefit, right? Excuse me. So, final thing today, I want to talk about how we beat this system that is designed to hurt us more than it hurts white people. Going back to what Lee Atwater said at the very beginning, you use this terminology, cutting taxes, cutting entitlements, cutting this, cutting that. It makes the racists happy because the end goal is it hurts black people more than white people, and that's what makes the racists happy. How do we beat a system that is designed to hurt us? Well, first thing is we stop playing the game, right? So in order to stop playing the game, we have to recognize that this is just a big game. And if we don't recognize that it's being played around us, then we can't win it, right? That whole terminology that's going around today about consciousness and being woke, consciousness is about seeing everything around us, all these levers and pulleys and the person who's pulling the puppet strings. It's not just about going and having all kinds of crazy theories about what the universe is, as opposed to somebody else's crazy religious theories about what the universe is, right? It's about seeing how all the mechanics of this machine, and I'm about to mix a bunch of metaphors on y'all, seeing how the mechanics of this machine work, seeing what the game board looks like. That is true consciousness. Being aware of the levers and the pulleys and the systems that are all in motion around us, and then looking around and figuring out, how do these gears work? What happens when I pull this one? What happens when I push that one? Right? Once you recognize the game as it's being played, now you learn the rules. And you learn the rules based on how the game is intended to be played. All right? You got to learn how the game is intended to be played, because the next thing that you got to figure out is what it is that makes you unique in such a way that you can change or bend the rules. Because there's certain things about you as a black man, as a black woman, that are unique, that give you an advantage based on certain rules about how this game has to be played today. But if you don't even recognize the game, you can't figure out where your advantages are. So we recognize the game, and then you figure out what it is about you that makes the rules work in your favor so that you can dominate the board, right? I like to use the example of The Matrix, right? I think that first movie was probably one of the greatest examples of what consciousness is supposed to be like. Right? You first recognize that there's something off with the way that all this stuff is working, right? And then you just make a conscious effort to pull yourself out of it. Then you make a conscious effort to figure out how to manipulate it. And then you just take your power into your hands and you change the way the game is played. Because once you are awake, once you know the rules that govern how everybody else has to play, and you are no longer subject to those rules yourself, you can accomplish anything. And that's what we have to do. We have to start being the people who figure out the game. Because I can tell you right now, most of the people on the other side of this don't realize it's a game either. They don't realize that they're playing, and they don't realize that the whole board is set up for them to win. That's why they get so mad when we tell them that it is, right? They think they did it all on their own. So they are not conscious, which means when we become conscious, when we start to pay attention to how this game is played, learn its rules, we can use it against people because they don't even realize that they're playing a game that's set up with the board in their favor. So they're not even making moves on purpose. They're just kind of stumbling around and, I won. How great. But when we do our due diligence, when we do our work, and we actually play the game the way it's designed, we can beat them every time. We can come out on top. We can win because we're actually paying attention. We never stumble into victory in this life. We never stumble into a windfall or a win. We always have to work for it, right? That's our advantage. Our advantage is that survival instinct. So we have to look at this tax reform the exact same way. We don't need to go out and argue and yell and complain about how unfair it is, how it's targeted against black people, how is this? Oh, yeah, we know it is. Absolutely. Absolutely. It is designed to do that. But how does it work? And what do I need to do to put myself in position to take advantage of it so that it doesn't do what they intended it to do? That's our job, right? So we have to redefine who we are in the United States to win this game, especially over the next 3 years and potentially the next 7. We have to redefine who we are. Right now in the United States, black Americans, we are the ultimate consumer. We consume 3 times more than anybody else in this country. We are the target dollar that everybody else is trying to get their hands on, and we give it up willingly. We have to change who we are, because this game, the board has just been set up for the producer, not the consumer. If we continue to consume at a rate that is higher than everybody else, we will be consumed by this next 3 to 7 years. And there will be nothing that we can do about it. So we redefine ourselves as producers. We have to start our own businesses. We have to create value for this market, right? And then we are going to create that value. We're going to take our profits, and then we're going to start investing it in things that appreciate, that grow more value. So we've come full circle, because everything that I just said we need to do, that's what this podcast is designed to do. It is designed to help us move ourselves from being the consumers of America to producers in America. And so, oh goodness. All right, I'm going to start back over, because I literally just said everything that was on my outline before I got to it. And I like the way I wrote it on the outline better. So I'm going to start back over here. All right. So it just so happens that is exactly what this podcast exists to promote in our community. We are currently America's biggest consumers. We are its most loyal employees, and we are its least successful entrepreneurs. I mean, by far the least successful entrepreneurs this nation has. And this is why when you use coded phrases like tax cuts, tough on crime, reducing entitlements, you can actually use those terms to speak to racists, and you can also use those terms to accomplish what they want, because we are the people who are going to get hit by the tax cuts. Tough on crime means randomly stopping and searching and maybe shooting black people, because, you know, we are crime, apparently. And reducing entitlements intended to be the exact same thing. So when we want to change the way this world works, we want to make sure that these policies don't disproportionately harm our community. We got to learn the rules to the game, use the existing structure to move our community from that position of consumption to production, and then none of those things hurt us. When we are producers, tax cuts help us. When we're out producing, running our own businesses, we're not the ones who are out there getting caught up in crime, right? And when we are producing, we're no longer asking the government to give us money. We're not asking for entitlements. So what that means is that we move the black community from being in all those roles, and that just kind of leaves the poor white community to be the ones who are hit with tax cuts, and the ones who are hit with the tough on crime, and the ones who are hit with reducing entitlements. And that's their problem. You know, we solve our problem. That's the long and short of this whole thing. We solve 99% of our problems as a community when we move ourselves from being net consumers to net producers. And this tax law just gave us a huge incentive to do that quickly, because the game is set up to favor the producer. When you think about this, you know, our smaller population in the United States, who we are, we should be able to adjust to things like this a lot faster than other groups. We're only 12 to 13% of the population. And so we should be able to adjust. When a change comes like this, we should be able to say, okay, pick it up, go form the LLC, start the small business. Now I am in the role of a producer, and I'm putting something out into the market. Now the game favors me. Because we're small, our community should be able to react like that. We should be able to make those changes. This is our advantage, right? Our competitive advantage is that we're small, we're agile, and we are constantly in survival mode. This is what David used to beat Goliath. He was smaller. He was able to look around and see targets of opportunity, see weapons of opportunity, And instead of having to wield this huge big sword, he could just grab a quick rock, sling it up there, boom, pop him, and the giant is slain. This is how our community has to start functioning economically. We need to be a community of economic Davids. Every opportunity that's thrown in front of us to take control of this game, we've got to be the people who are ready to jump on it and to make that change before anybody else can even realize that the rules even shifted. Let's become that group of people. Let's become that community. All right, guys. So this was, as I expected, a little bit of a longer episode today, but there's a lot that happened with the tax reform, and it was a lot that we needed to cover. So I won't ramble on about that. I'll just throw in some closing remarks today. The key thing is that buyblackpodcast.com is up, and that resource site, that's where you need to go to find everything that you need. The other pieces here, I want to start communicating to you guys. There are only 3 places that I'm going to recommend that you go to get this show going forward. I have the iPhone app. All right, if you have an iPhone or if you have an iPad, if you go to the App Store, not iTunes, but you go to the App Store, you can download the Buy Black Podcast app directly from the App Store. When you do that, now you don't have to worry about, searching for the episodes or any of that stuff in other podcast players. Literally, whenever I drop a new episode, you will get a notification on your phone. You'll be able to get the episode. And once we get into the year, I'm going to start putting out some content, some additional content that is only available if you have the app. Right, so that's one thing. The other thing, I finally have the Android app that is being developed. This one was on me. I thought that I put in the paperwork to have that thing developed months ago, but I didn't. But I finally got that done. So the Android app is underway. That shouldn't take more than a couple of weeks. So we will have the Buy Black Podcast app in the Android market as well. Once that is up, again, I'm going to discourage you from going anywhere else to find this show. Obviously you can get it on iTunes, Stitcher, you can get it on Google Play, you can get it on TuneIn, you can get it on iHeartRadio. But I want you to download the Android app. If you have an Android, I want you to get the iOS app. And now everything that you need for Buy Black Podcast is right there in one central location on your phone. It's got its own little, icon, and you're not having to search for it. The other piece is the website, buyblackpodcast.com. If you're talking to anybody, if you want to direct anybody to learn about the show, all right, if they've got a Samsung or if they've got an Android, you can just tell them, hey, go to the App Store, download the app. Even if people don't listen to podcasts, they know how to use the App Store. So that makes it simpler for you to help me spread the word on this. Same thing on the iPhone. And then if you want to actually get to all of the resources we have available, go on to buyblackpodcast.com now that it is up. It's a beautiful looking website, and as I understand it, it's pretty functional as well, pretty easy to navigate. So 3 places, y'all. 3 places I want to send you in order to get this content. iPhone app, Android app, buyblackpodcast.com. You talk to anybody, iPhone app, Android app, buyblackpodcast.com. I need you guys to help me start getting the message out about this show. We're going to do some tweaks with the format this coming year. I've got a lot of people lined up for interviews that will be coming down in these next couple of months. I am so excited for where we're taking this project going through 2018. I want you guys along the ride with me, but I also want to grow this thing. Everything for the first 6 months, it was about getting established. It was about getting a rhythm. It was about getting the platform built. Well, now that we have the platform, we've got exclusive platforms. We got our own app. We got our own app on the other store, and we have our own website. And we can do with this platform whatever we want, y'all. I built it from scratch, which means there's nobody else here to tell me how to run it except you. I want your input on how we need to take this thing going into 2018 so that we can make this platform whatever we want. We're going to do it together. We're going to make it huge. But we got to get engaged. We got to get involved with each other. So if you have any questions, anything, reach out to me. You got my email, gerald@buyblackpodcast.com. You can also find my phone number on the website, on the Connect page. Any feedback that you have is great. Any businesses that you feel like I need to connect with are great. Anything I can get from you. I love the emails, the connections on social media, everything, man. You guys keep me going with this. Sometimes, because I got so much other stuff going on, it's hard to record, but I'll get that email. I'll get, a hit on social media, somebody telling me how an episode really helped them out. And honestly, y'all are the ones that keep me going with this, where some days I'm just like, man, I don't have it in me. Y'all put it there, and y'all make me keep going. So let's keep that going and make this an incredible 2018. And with that, thank you for dealing with my ranting and raving tonight. That's all I got for you, y'all. I will see you on buyblackpodcast.com. We out. Thank you for being part of the Buy Black podcast community. If you're enjoying the show, I'd appreciate reading your 5-star review in iTunes. Join us next time for another empowering episode.